Welcome to the Daily Update, where I'll go over the action in the market for Friday, June 30th, and then we'll see how things look for Monday, July 3rd. One quick little bit of information. I think I've been upgraded from terrible to crappy, but I'm going to go ahead and try to do a full-length video this time. Also, the notes that I go through at the beginning of the video, that's been placed as just an end card at the very end of the video. Getting back to what happened on Friday, we had a really solid update. Now, it looks a little bit more radical because the last few days, the range between the high and the low had been kind of small. Well, we saw a pretty solid up move on Friday that went all the way above R3 that I'll show you here in the chart. It has switched our indicators to positive, but on a short-term basis, we're already overbought. When we chop around the way we have been, it doesn't take much to push us into an overbought or oversold condition, but nonetheless, we're still turning more positive overall. Let's go back and talk about what happened. Right at the open, we had a huge gap higher. Now, huge is on a relative basis. We've had higher gaps before, but if you look at this on the daily chart, there is a gap from Thursday to Friday. We did have a gap higher open above R1 at 4406. So yes, we got back above 4400. We also went immediately up above R2 at 4415. Prices then kept on climbing up above R3 at 4442. Prices chopped above and below R3 before breaking above R3 and then closing at 44.50. Kind of a nice round number for the end of the month of June. We were up 1.23%, even though it seemed more than that if you were watching things. Volume was still below average though. It was the last day of the week, month, and quarter, but still, volume didn't really spike up. We are positive, but overbought in the short term and somewhat in the intermediate term. We're still fixated on this inflation and interest rate scenario, where we're still continuing with this shift that we've been seeing, where good news is now good news. We don't seem to have the problems with growth concerns that had been developing just a week or so ago. We also want to keep an eye on what's going on in Russia and that whole crazy situation. So, what are some comments that we can make? It was the last trading day of the week, month, and quarter. Economic data that came out was taken as positive, and I'll go through that. The mega caps were strong, and then they brought along the rest of the market as the day kept going. Apple was able to get above the 3 trillion market cap. I remember when they climbed above 1 trillion. There is growing optimism that the U.S. economy may end up, in fact, avoiding a recession altogether. We don't know if it's really going to play out that way, but more people are starting to think that. The MOVE Index and the VIX are diverging. Again, I'll show you the chart. I'm not quite sure what to make of that because we don't have a lot of historical data on the MOVE Index to really do a comparison. Here's a long list that didn't even exist before Friday's session. The 20-period exponential moving average, the Williams percent R, the CCI 14 and 20, the stochastic, standard deviation, Arun, the S&P 500 McClellan oscillator, the PMO study, the RSI based on 9 periods, and the boom indicator based on 20 periods. Intermediate term, we're still keeping an eye on our oscillators. They're not really rolling over to positive yet, but we see any more follow through and they just might do that. But they're still looking rather extreme relative to where they have been in the past. The Sean trend meter and the rate of change based on 200 periods, that's usually a long-term indicator, but we're looking a little bit more in the intermediate term that we could be overextended. So I have a chart to show you of that. The dollar was down and interest rates were down, and both of these gave some support to stocks. We still have all of the yield curves that remain inverted that we've been watching. Sentiment really didn't change. It's at 80. It's still extreme positive where it had been at 79. Our trend is now positive and the green line has turned back up, so we're advancing. The ADX is just barely crossing back above the moving average, and both of them are above 20. Our bias is now positive and our momentum is also positive. What are the economic reports that came out? We had personal income come in up 0.4% on a month-over-month basis. That was as expected and a tick up from last time. Personal spending came in less than expected at 0.1%, where they had expected 0.3%, way down from the 0.6% that came out last time. The PCE price index came in at 0.1% as expected, down from the 0.4%. The core PCE price index, when you take out food and energy, the things that you have to have, It was up 0.3% as expected, down from the 0.4%. Then on a year-over-year basis, the PCE price index was up 3.8%. Last time we had this report, it was on an annual basis of 4.3%. On a year-over-year basis, the core PCE price index was up 4.6%, a tick down from the 4.7% that we saw last month. Now, the takeaway from this is, yes, things are falling, but they're not falling apart. So we're kind of in that Goldilocks period right now where it's just right and the market likes what it saw out of all of this report. And that is why we're seeing a little bit more optimism and we saw a really solid advance for the market. The final reading of the Consumer Sentiment Index came in at 64.4, a little bit more than the 63.9 they had expected. In the same period a year ago, the index was at 50. The Chicago PMI came in at 41.5, up from 40.4. Above 50 means expansion and below 50 means contraction, so we are still contracting. Here's a look at some charts of the economic reports. Here's personal income and spending. The blue line is spending how it has been trailing off, but not really falling off a cliff. Income's also been leveling out. Then we have the core inflation on a year-over-year basis. It is declining. It's still there, but it is coming down, just like the other reports that we've been seeing. Personal spending on a month-over-month basis did decline, but it didn't go negative. Here's a chart that I have. Here's the PCE index, the cumulative value over time, over the 12-month period, how it has been coming down, and then on a month-over-month basis, how it's been declining, but it's still positive. Then we have the Chicago PMI, which had been falling a lot more. It bounced back up. It's coming down. It bounced up a little bit, but it's still below that important 50 level. Looking at some IsabelNet.com blog charts, this first chart is just indicating that the U.S. market is overvalued. We're at 19.4 overall. Then this chart, which really looks kind of funky, it just shows all the different yield curves and how so many of them are inverted, and they are way inverted. The last time we saw them falling this low was back in 1980 into 81, which was a very difficult economic time. Equity flows into funds did turn down a little bit, but still remains positive on the 12-week average. It also shows where there was a decline for the week. Right now, in the second quarter of 2023, the earnings per share estimates are coming in at minus 8%. That's not what the market is really focused on. They're focused on these forward-looking numbers, and they're looking a lot more rosy. This is another chart which, again, people differ on this, where they're talking about the structural bull and bear market. There's also other terms that I'm more used to called a secular, which is long-term, versus cyclical, which is shorter term. This just talks about historically when we've had good times and bad times, and that it's just an overall fact of the stock market. Then those that are in cash versus the long-term average, the blue line is the average. They're not in cash as much as they have been historically. Now, this doesn't really take into account money market funds because people put money in there and just keep it in there. It's not necessarily a parking spot to put into the stock market at some future point. Looking at housing sales where they have been dropping, this is the dark blue line, and then we can compare that to the other years where typically we see a real downturn from this point going forward. Just to keep an eye on the UK, these are flows where they tend to be more negative overall, and the 4-week average is also showing that we are seeing outflows. Couple of charts from Real Investment Advice. They're just talking about the first half against the second half. Basically, the idea is when we have a good first half, we also have a good second half to the year. Then this is just showing that small caps are undervalued when compared to large caps, and they did a ratio between the two based on a valuation basis, and we're getting down to that -2 standard deviation, which could be a buying opportunity for the small caps. They have been underperforming, even though they have periods of good strength. It would really help the overall market if small caps could get a fire lit underneath them and then stay underneath them for a while. Here's another chart showing bank profitability. When they lend out money, it has been declining. And here's another chart showing how lending standards have been increasing. So you can kind of see the correlation between they make less money when they loan out less money. Keeping an eye on the Fed. I like to do this about once a week. We're still a ways away from the July 26th meeting, but as of Friday, There's an 86.8% chance that the Fed will raise rates 25 basis points. Now, this is going to jockey all over the place between now and then. This is just how it stands right now. And here's a look at where we are right now, the dark blue area. Then we have a day ago, a week ago, and then a month ago. More people are getting into the camp that there will be an increase at the next meeting, but we still have a ways to go for that to happen. Getting into our charts and analysis, here's the intraday chart. We gapped up above R1, R2, and then immediately shot up to R3 right after the open. We tried to dance around a little bit on R3, but then instead of falling back, we actually took off and went higher, closing a little bit down, right about at the 44.50 level. Here's the intraday chart, also showing that we were seeing some good strength in the pre-market session, and a lot of that just kicked right in when we opened. For the cash session, we came down a little bit and were flat as the futures ceased trading for the weekend. Growth versus value, didn't see a real big change there. They're more or less neck and neck, but both were up strong. So on a closing basis, growth did outperform, being up 1.33%, even though value was also up. It also outperformed for the mid caps as well as the small caps. And this is a little bit encouraging. We did see a good solid up move in Friday's session. Sentiment going up a little bit higher based on the Ulcer Index. We're getting to that point now where the VIX is starting to act a little strange. We were up on an up day, both with the line chart and the bar chart. Volatility is continuing to drop off, and so I brought up this next chart. We're starting to see the correlation between the VIX and the S&P get a little bit stronger now. We'll really pay attention to this if we go above this dashed line, because any fear that's coming into the market is not necessarily being reflected in the VIX. The equity put call ratio continues to fall because we had the up day, and we're still seeing this turning more positive, even though it's going down. You have to look at it in the inverse way. When we were having trouble in 2022, this ratio was going up. Now that we're doing better, this ratio is coming down. The VIX to move ratio is still showing there's not a lot of fear, and we're below the moving average. Then looking at the move index, it was up in Friday's session, where the VIX was a little bit up. And what's interesting about this is they usually have a real strong correlation. We're starting to see them move more in opposite directions. We had the latest reading from the American Association of Individual Investors. Didn't really change all that much. They're not extreme positive right now, but they are positive nonetheless, so we can go with that until they get up to this extreme optimistic level. Here's the final reading for consumer sentiment, where it did tick up slightly, but there's still a really wide spread between the 2-year yield and sentiment. They tend to go in the same direction, and they tend to not get too far apart from each other, even though they're on different scales. The latest reading from the active asset managers did show a bit of a decline. It'll probably tick up in the next reading because we had the solid Friday that was up. No longer above 80, so it's more in the neutral area, still with a positive slant. This fear gauge is suggesting that fear continues to subside, and this other fear gauge is also going down. Folks are still maintaining a risk-on posture. Looking at our advanced decline line, we saw a nice breakout based on price to reach a new swing high, and we're seeing a lot of improvement now based on volume. The new highs just really skyrocketed up. It hasn't really affected our 5 period yet. It's mostly going sideways, but our 10 period has turned up slightly. The advanced decline ratio, both the blue line and the red line, are above 50 and advancing. Accumulation distribution is above an advancing moving average. We're seeing some improvement with the cumulative advanced decline line for the NYSE. We're also seeing our regular advanced decline line showing some improvement. The other advanced decline line study that we look at is also showing that we're breaking out above this trend line. We're also seeing improvement with NYSE common stock based on price and volume. Then looking at the NYSE advanced decline line, showing some strength. The S&P was up. Mid caps showed a lot of improvement. Small caps, even though they're improving, did tick down slightly. In Friday's session, the small caps did underperform. Looking at our trend, where the green line is now going back up, the ADX has turned just barely above the moving average, so we can now more or less default to positive. And on a short-term basis, also turning back up with the green line also going higher. Volume did drop off and continues to be below average. Short term, here's where we're breaking out. We actually exceeded the previous high on a closing basis. What I'll probably do pretty soon is extend this trend line to see if that's going to produce any kind of overhead resistance. Down on the bottom, we see where volume was just a little bit below average. We did break out above the 20-period double and triple exponential moving average, so that is more positive. Looking at our moving average study, the 20-period exponential moving average is starting to get extreme positive. We're still showing improvement with the 50 and 200. The Stochc RSI, not extreme positive yet. It had been extreme negative just a couple days ago. And the Williams percent R, though, has gone back to being extreme positive. The CCI 14 and the CCI 20 are giving us extreme positive readings. The stochastic short term already extreme positive. In the intermediate term, showing improvement and turning back up with the longer term. And if we continue to turn back up with the longer term, we will already be extreme positive. The force index is not extreme right now and is looking more positive. Intermediate term, balance of power, showing improvement, not extreme positive, at least yet. Looking at the 50-period double and triple exponential moving averages, we have been able to break out above both of them. The go-no-go system has switched back more to positive with a dark blue bar. Our highest high and lowest low values were getting up near the top here. The TTM squeeze, though, still continues to decline. We're up into the third standard deviation now, suggesting that maybe we've gone up a little too far too fast. The Erin is also giving us an extreme positive reading, showing us that buyers are in control, sellers are really declining. Looking at the PPO studies, they're positive with the short, intermediate, and long term. McClellan oscillator for the S&P 500 starting to get a little extreme positive. With our summation index based on price, we're turning up, and we're turning up now based on volume. The NYSE McClellan oscillator is above zero and advancing and not extreme, showing some improvement with the summation index for the NYSE turning up based on price and volume. Swenlin trading oscillator, after having been below zero, is now advancing based on price and volume, turning back positive. The Elder Impulse system for the S&P is positive. The PMO is trying to roll back over. Overall, we're turning back up based on price. We're still negative based on volume, but turning back up. The PMO study, we're already getting extreme with the PMOs that are rising. We're improving with the buy signals, and we're turning up with the PMOs that are above zero. This is another critical thing too. The parabolic SAR system now has a dot underneath, so we've gone from being negative back to positive. The slope, trying to turn back up, but is still negative, where the MACD is trying to turn back up but hasn't quite crossed its moving average. So when we look at our oscillators, in the short term, we're still negative, showing some improvement in the intermediate term. We're pretty much flat in the longer term. The Sean trend meter starting to get extreme positive. The BPI did see a bit of a breakout and not giving us an extreme positive reading. The NYSE bullish percent index also turning up and is above 50, showing some improvement. The Chaikin money flow continues to be positive. The Chaikin oscillator crossed back above zero and is now turning positive. The money flow index was pretty much flat, but we're still above 50. Ultimate oscillator above 50 and advancing. The vortex actually ticked down a little bit with the buy and the sell, but we're still positive overall. RSI based on 14 periods showing strength, starting to get extreme positive with the RSI based on 9 periods. The boom indicator based on 20 period moving averages is starting to get extreme, showing some improvement with the 50 and the 200 period moving averages. On balance volume, turning back more positive. Showing some improvement with the 200-day moving average study, where we're possibly breaking out here, and we're also looking to be breaking out with the 50-period moving average study. Here's another look at that same chart. Pring bottom fisher. This signal is just about ready to go away. We're getting ready to cross below that. That's not necessarily a negative signal. It just means that this buy signal has worn itself out. Going through our Fibonacci and line studies, we're turning back up and possibly heading into an area of resistance based on our quadrant study. We're well above the 100% retracement level now with this fib chart, since we are still above the August 2022 highs. We're also above the 61.8% retracement level on this longer term fib chart, And we've got a long ways to go because the next level to reach would be going back to the all-time high on this chart. Our different charts, the Heiken Ashies turning back positive. The Kegi continues to be positive. The Renko is positive, and the 3-line break is now turning back more positive. We also had a new X drawn in with the point and figure chart. Not a new signal. We're still working off of a double top breakout that was generated on May 18th. Looking at our different indexes, the equal weight index, it's still underperforming the S&P, but it is showing some improvement. And the ratio ticked up just a little bit, showing that there was a little bit more broad participation. Now, I want to point out some things with the transports, and I have some charts that I had to kind of dust off to show you. We're seeing some real strength right now with the transports. They're breaking out above previous high levels. The Dow is still looking pretty good, so these would tend to confirm each other. Now, when we look at utilities, it is turning up, but we're seeing some weakness overall here. I have one trend line going down this way and then another trend line going from this high to see if we're able to break above that. Then looking at the transports, I have a ratio between the two, and if you look back in time, when the S&P was doing good, the transports were also really doing well at that same time. When the transports were really suffering, so was the S&P, and vice versa. There are times when we started to go up back in 2022 where the market was looking a lot more positive, but the transports were actually going down. And then when we were going up and then chopping sideways in earlier 2023, we saw the transports really going down. So we want both of these indexes to be able to confirm each other. Then another study. Here's the transports on top, just showing the correlation between the transports and the S&P 500. They tend to correlate very heavily. We got a little bit out of line here for a while, but now they seem to be coming back. The transports are showing some improvement, but are just barely underperforming the Dow. Now, that was all based on traditional Dow theory. Let's look at new Dow theory, where we take the S&P on the top, where it's starting to break out, and the NASDAQ, which is more of a representation of the kind of world we live in now, where it used to be industrial stocks on top and railroads on the bottom. Now it's more of the big stocks of the U.S. compared with tech. We're seeing a little bit of a negative divergence here where the NASDAQ hasn't quite broken out to a new high, even though it's been doing really well overall, where the S&P has broken above this previous high. We want to keep an eye on that, but it's probably not a real big concern at this point. Discretionary had another good day, gapped higher. Staples were up just a little bit, but on a relative basis, the ratio is showing that discretionary is outperforming staples. The Dow did lag behind some of the other indexes, but still had an up day. The diamonds continue to be positive. The NASDAQ still dealing with this overhead resistance and didn't have as strong a day as maybe you thought it would, and you can see at the bottom where volume did really drop off. We're still below the 61.8% retracement level. The new highs, new lows on a cumulative basis continue to decline, even though overall the indicator did go above zero. We're also coming back up to this previous high that I pointed out before. Is this going to be a problem? We saw a little bit of a pullback. Will the NASDAQ be able to break through this level? The Qs, however, have switched from neutral back to positive. And the NASDAQ 100 is well above the 61.8% retracement level. The next level up would be the all-time high. The NASDAQ 100 BPI is showing some improvement. Earlier in the week, this was flagged by David Keller from StockCharts.com as being a major signal. I just saw it as part of the overall big picture, but now it seems to be showing some improvement. The small caps, this is a little bit negative, where they actually closed at the low for the day, and they're still battling around this kind of conglomeration of prices after breaking above this resistance level. But for the Elder Impulse system, the small caps still remain positive with a green bar. The RSI is showing a lot of improvement, going above 50. The MACD is still negative, but trying to turn over positive. And if you look down at this green line, we actually closed above what had been support, which then turned into resistance. We closed down a little bit below that. But also on a positive side, the 50-period moving average could be getting ready to cross above the 200 to give us a golden cross. The small cap ratio did tick down just a little bit, but still are underperforming the S&P. When we compare small cap growth with small cap value, we're still in an overall uptrend, but not a really big upward move. The mid caps showing more strength here and breaking out above this whole mess of prices. The elder impulse system for the mid caps remains at positive. And when we compare mid cap growth to mid cap value, we're seeing continued strength and an overall uptrend. The home builders still continue to show a lot of strength. The ratio was down because the S&P actually underperformed the home builders, but our relationship between the two is still very strong. Looking at the broad market and comparing it to shorter term bonds, we are outperforming with stocks. Then the tech sector with further out bonds also continues to advance. Another broad market measure with further out bonds also showing that stocks are outperforming. The S&P to the 3 to 7 Treasury bond ETF is still showing that stocks are outperforming, and this is also suggesting that we may see a soft landing. Home construction, on a relative basis compared to bonds, just continues to outperform. This is the rate of change based on 200 periods. Now, this is a long-term indicator, but see how it's coming above previous levels before? But when you look at it on a longer-term basis, we might be intermediate term overextended, but longer term, we still have a long ways to go. Keeping an eye on the banks, the financial sector was up 0.87%, but still continues to be in a downtrend. Then the financials tick down when compared to the S&P 500. Here's a new ETF that I want to keep an eye on, the bank ETF, where it's in an overall downtrend. And this ETF actually ended up being down on Friday. And then we look at the regional banking ETF and compare it to the financial sector, where the regional banks continue to underperform. Switching over and looking at bonds, where we had yields coming down and price going up. Price is just a little bit above its 200-day moving average. The RSI is still below 50, but is showing some improvement. The MACD continues to be getting ready to cross over negative. Then we're still looking at this, which is kind of strange. We're seeing a real discrepancy between the S&P 500 and the long-term bond ETF, where the S&P is shooting up. Bonds are just kind of blah, 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 where the longer-term correlation between the two is showing that they're having a tendency to go in the opposite direction. The shorter-term relationship is also showing that they're going in opposite directions, and the spread just continues to get wider. This is also another concern. When we compare cash to the 3 to 7 year bond ETF, if the market was more convinced that interest rates were under control and they felt better about the future, this ratio would be going down. It continues to go up. If it keeps going up, we're going to see a golden cross with this ratio. But folks are still tending to prefer riskier bonds over more conservative bonds to get a better return. And then this is an inverse of another chart that we look at showing where bonds are really underperforming stocks. And we're also keeping an eye on this 3-month yield where it's above the 2007 levels that happened right before we saw the great financial crisis occur. Long term, the special K is still looking positive on the daily chart, still looking negative on the weekly chart. Our longer term moving averages were showing improvement with the 150 and 200 and not extreme yet. And then an update of our possible positive scenarios. We are advancing based on price and volume when we look at the 19-day exponential moving average of the advanced decline ratio. But when we look at some of our growth to value ratios, we actually declined with the Qs to the S&P, discretionary to the S&P. Large cap growth just barely outperformed large cap value. Some of our other growth to value ratios, large cap, a little bit up, a little bit sideways to up with the mid caps, and actually decline with the small caps. The stocks that are above their 50-period moving average that are in the S&P is continuing to show improvement. We're seeing improvement with the mid caps, and we're also seeing some improvement with the small caps. The percent of stocks in the S&P 500 that are above the 200-day moving average continue to also show some improvement. The S&P to utilities ratio continues to go up, and that could continue to give support to the S&P. When we look at the broad range of the 5-period moving average of the highs minus the lows, we did finally cross back above zero. With the 10-day average of the S&P 500 highs minus the lows. The longer we can stay up here, the more that suggests it's good momentum and not a blow-off top. When we look at the 50-period exponential moving average of the new highs minus the new lows, we're showing some improvement. But when we look at the short-term indicator, we're starting to get extreme. Now, we could go higher than this, But if this really starts to go up, that could suggest that our indicator is starting to get overextended. Nonetheless, the red line, which is what we based the previous chart on, that continues to show improvement. But another area that's a little bit of a concern is when we take S&P growth and compare it to S&P value. We're declining overall, even though we continue to be in an uptrend. We weren't up all that much in Friday's session. But the staples to S&P 500 ratio continues to decline, and quite often that can continue to give good support to the S&P. So what's our outlook for Monday? On July 3rd, the market will close early at 1 p.m. Eastern Time, and then it will remain closed through July 4th. The technicals are positive and showing improvement, but on a short-term basis, we've skyrocketed into being overbought, and we're a little bit overbought in the intermediate term. We have the IHS Market Manufacturing PMI coming out. That'll be the final one on Monday. We have construction spending also coming out. And then the big one will be the ISM Manufacturing Index. Geopolitical events, keeping an eye on Russia, which now also includes Belarus, just in case that situation explodes and eventually feeds over into the market. Right now, the market continues to be focused on inflation and interest rates. The growth concerns that we were seeing a week ago now seem to be dissipating slightly. Here's the economic calendar for the upcoming week. We will get the big employment situation report that is due out on Friday. Here's a new look, and I'm going to take a minute to go through this, where July is the best month of the third quarter overall. We see most of the strength in the first half of July. It's also the start of the Nasdaq's worst 4 months of the year. And now this is further out, but when we get to options expiration, we're up 57.1% of the time. We're down 42.9% of the time. The week after options expiration, it's 50-50. But looking at July 3rd, which will be Monday, we are very positive across the board. Then when we look at the last 72 years, July has been up 58.3% of the time, and it's been down 41.7% of the time. And then this is the backdrop that I keep referring to in every video. These are yearly scenarios that we have behind us. The first one is the January barometer. And going back to 1950, the market follows whatever happened in January. It follows that 83.33% of the time. We also have the January trifecta, and we have a score of 3-0. The first score was the Santa Claus rally. The second score was the first 5 trading days. The third score was how did January do? All of them were positive, so that gives us a score of 3-0. When all 3 indicators were positive, and you look out from February on, we're up 87.1% of the time with an average gain of 12.3%. When you look at all 12 months of the year, we're up 90.3% of the time with an average gain of 17.5% in all years. The market also likes that we are split between Republican and Democrat in Congress. Here's the new chart for July, where on Monday we will be in the first trading day, where we tend to see a lot more strength at the beginning part of July. Then we kind of chop around a little bit, and if weakness starts coming into the market, it tends to be about halfway through the month. We're also keeping an eye on this, which is being confirmed by the previous chart, where the Nasdaq tends to perform well up until the middle part of July. So what are our scenarios? Can't really go with the down one. We're just too stinking positive right now, other than the fact that we are short-term overbought and a little bit overbought in the intermediate term. But all of our charts are now positive, but we are overbought, so that's something to be aware of. We also have positive seasonality behind Monday's session. And we definitely can't go with the sideways trend right now because both of our ADX charts are showing that we're in a strong trend, and that trend is positive. Some warning signs. The BPIs are still diverging just a little bit when you look at the broader range. The S&P BPIs are looking much better. The VIX is showing that there's a lot of complacency, and the VIX may be starting to act kind of weird. That's why I brought up that other chart. The cumulative new highs and new lows for the Nasdaq continue to show weakness. We're still above the 3-month yield going back to the 2007 levels. Earnings season can either be positive or negative. On the positive side, the parabolic SAR has now turned back positive. We have longer-term positive seasonality and setups, and I just went through some of those. The long-term special K based on the daily chart is positive, where the weekly chart still is negative. The longer-term equity put-call ratio chart that we look at is still staying more positive. The S&P is above the downtrend channel upper line. We're way above that now, so I haven't been including that chart. We're still in a risk-on posture. The Dow transports are improving and may be breaking out. We'll keep a close eye on that because there's a real strong correlation between the transports and the S&P 500. Lower price levels may provide some kind of support if we start to fall. So far, the support that we've been looking at has been holding. The S&P is outperforming utilities, and the NASDAQ and NASDAQ 100, even though they didn't have a gangbuster day on Friday, they still were going up, but they have that overhead resistance, especially with the NASDAQ 100, and the NASDAQ has that 61.8% retracement level. The Staples to S&P 500 ratio is declining, and that often gives support to the S&P. Mid-caps have generated a recent golden cross, and small and mid-cap growth, especially mid-cap growth, continues to be positive. So our conclusion, the S&P is positive, showing improvement, but it's becoming more overbought in total. On a short-term basis, it's positive, but we are overbought. Intermediate term, we're a little bit overbought. We're still positive in the long term. Thank you. I appreciate you putting up with my voice. I will edit out all the coughing and hacking that you won't hear. I hope you have a really nice weekend. I will do my best to put out the weekly and intermarket analysis videos as well as the deep dive video. Have a great weekend, and I will talk to you in the next video.